How do loan officers come up with a number that you're pre-approved for? They don't just pull it out of thin air. They actually use an equation. Now, there are a lot of factors that go into this equation, but we're gonna get down to the crux of it. We're gonna get down to the real meat and potatoes, and that's DTI, debt to income ratio. While credit, assets, and loan type matter, DTI is the key equation on how we figure out what you're pre-approved for. Today, let's go over a fictitious scenario and see how we go through it. Let's say we have John and Jane Smith come into my office and want to know how much they're pre-approved for. They have a household income of $120,000. They have about $150,000 to use for a down payment. They're looking for a single family and they want to know how much they can afford. The first thing we're going to do is take their qualifying income and divide it by 12. In this case, it's an easy $10,000 a month. Now, debt to income ratio, here's where it comes in. Most banks will underwrite to about a 45 debt to income ratio. Now, we take that $10,000 and multiply it by 45% and we get $4,500. That is the maximum amount of debt, including their other debt aside from their mortgage, that they can have in order to qualify. So what do? We run their credit and we see what other debts they have to put in this equation. Now, in this fictitious scenario, John and Jane have a car payment of about $200 and they have credit card payments for $100 a month. So we'll take that $4,500, we'll subtract the $300, and that gives us $4,200. $4,200 is the maximum their principal, interest, taxes, and insurance can be. Their total housing payment cannot exceed $4,200. So what do we do from here? We take our trusted mortgage calculator and we plug in the information. Now, in this scenario, we're going to use a 6.5% 30-year fixed. So we have the interest rate, we have the term, and we have the payment. And we ask it to solve for the missing number, which is the loan amount. In this case, it comes out to be about a $560,000 loan amount. If we take that $560,000 and consider that they have $150,000 to use for a down payment, that would equate to a $710,000 purchase price. Now that Jane and John know that they're pre-approved and what their payment is, they can confidently go back to their real estate agent and say, here's my pre-approval, let's go shopping.